morning, and welcome to the live series Straight Off the Bat. Join us on Thursdays as we speak to individuals across multiple industries that will help you understand financial literacy and education. If you're joining us from Facebook today, thank you so much. Don't forget to like and follow our page to stay updated with content that will help you manage your money. I'm your host, Pauline Joseph, and May is Investor Education Month. And even though the month is almost over, I know, where has the time gone? It's never too late to start the conversation about building wealth through smart investing. Today, we're diving into a topic that's perfect to anyone ready to take their first step: what every beginner should know about investing in Trinidad and Tobago. And today, we're joined by Philip Williams. He is the founder of Fill the Gap, a company that is focused on helping people find and fill the gaps in their financial knowledge. He's a registered investment advisor accredited by the Trinidad and Tobago Securities Exchange Commission, and he has over 2 decades of experience within the financial service sector, both locally and internationally. Let's welcome Philip Williams. Yay!
Hi, Pauline. Hi, everyone. How are you this morning? Very happy
We're
to be
good. And I know you don't know this, but you're one of the OGs of the Straight Off the Bat show, and your YouTube video is the most popular of all the videos we've created over the last 4 years.
Oh, is it? All right. That could very well be the high point of my day. Thanks for letting me know that. I'm pleased to know. I'm pleased to know that. I didn't know that. Thank you. And again, I'm very happy to be here and to have this conversation with you, Pauline, and everyone who's joining.
Fantastic. So in case you want to know the video I'm talking about, we're going to put it in the comments. A lot of things we're going to discuss. You want to make sure and sign up for the Straight Off the Bat newsletter because there's a lot of information that we're going to cover. So let's get straight into it. Let's talk about what exactly is microinvesting and how does it differ from traditional investing?
So, micro investing is a way to invest small amounts. So I think I will start by saying, a lot of times people think, or you have that feeling that you need a lot of money to start investing. And that is not the truth. So micro investing is a way to, I would say, allow a beginner, somebody who's new, and you may not have the large capital, but remember when you start small, that's how you build up, right? So micro investing is a way, simple, just to invest small amounts. It's usually done on an app. Sometimes you may have like some shopping providers might allow you to round up your purchases and invest consistently or continually. And it's a good way for someone to start. I haven't seen much of that in Trinidad. I know like abroad I've seen it, but micro investing, just in very, very simple terms, it's a way to start investing small amounts so that you eventually build up to having a big amount. That's how you start investing, starting with what you have.
Yeah, and I think most of us who are joining us, including me, the idea of investing feels like rich people problems. So when we talk about investing, because I saw a post on social media where someone said, if you save $100 a day, it will end up being $1,000 a week, which in its sense is not nothing, but at the same time, who has the $100 a day to put aside? So Realistically, where does one start investing? Let's say we have that $100, so maybe a month. I don't know. Give us some insight.
Yeah, and I want to. It's how you mention it. Rich people problems. It's not. I mean, how people accumulated wealth. They had to start somewhere. So I'm hoping that anybody who's listening, that they do have the belief and faith that they can start investing with what they have. So I would say the best place to start investing, well, here's what. The first place to start investing is really an assessment of yourself. Because as with anything, there is risk involved in investing. There are different types of investments. So it's really, I would say, a self-assessment in terms of how comfortable you are investing. Let's say if you had $1 and you invested it, and then the day after or the week after it was 95 cents, how would you feel about that? Right? There's some people who will be terrified about that. There's some people that are comfortable because maybe the week after it may be $1.05. And that's how some investments work. But the best place to start. Well, that's where you start, right? You start with yourself assessing where you are, what's your risk tolerance in terms of your comfort level in investing, and also looking at, what's your financial situation, because some investments might require you to leave it settled for some time, and you may not be able to have access to it. So I would say a self-assessment, but a great place for a new investor would be a mutual fund, I would say. Starting with a mutual fund, and a mutual fund is really like, just think of a basket of investments pooled together. That's a great way, and a professional money manager manages that money for you. That's a great place to start for someone who wants to begin, and you don't really have the knowledge to know what type of investments to make. I would say starting with a mutual fund.
Okay, so you used a term there that I think it's new to a lot of us, which is risk tolerance, and I think it's extremely important for us to understand what that means, because we are, as a species in the human race, have this tendency to want to have everything quick now. That's why you have these lose weight now things being multi-million dollar industries. So, can you expand a little bit more about risk tolerance? Because the idea of me investing in $100 and seeing it going down to $50, and then maybe it might go back up to $5,000. Like, what?
Yeah.
So, just
So
explain to us what that means.
yeah, good, good. And that's a thanks for that. So it's a fancy way just to say, and it's looking, examining you as an individual, and your comfort level as it relates to your money, and what type of risk you're prepared to take. So, risk tolerance. So, any good financial advisor, financial planner, or like an investment house, a financial institution that is selling financial services, particularly investments, should do an assessment, which is through a risk tolerance. And they ask you a number of questions to gauge, like one of the typical question that would be asked: how do you feel if you invested $1 and the following week it's 95 cents? And you answer, and when you answer those questions you get a score, and the score will tell you, how risk averse, how what's your comfort level when it comes to taking risks. There's some people, most people, they want to double their money, they want to see the money grow quickly, but they don't want to take any risk. So let me just rewind. It doesn't work like investing, doesn't work like that. It doesn't, your money just doesn't double overnight. There is risk in investing, but once you understand the type of risk that you're going to take, I think that's important. And I think also what's important to understand for the person that doesn't want to take any risk, you say, what, Phil, I cannot, I wouldn't be able to stomach that. Like if I put in $1, I expect to see $1. I do expect to see it reading at 95 cents in my account. I would say that there's risk in not taking risk, particularly for a younger person who has a lot of time and who's working towards some of the big financial goals. Investing is one of the ways for you to get to those big goals. So you're gonna have to take some risk. So your risk tolerance really is just an assessment of yourself. So even if you find out, listen, you know what, I'm extremely risk averse, I don't want to take any risk. That's okay. It's good to know yourself. But it's also good to know exactly where you are in terms of age and stage of life. So those are questions that are asked as well. How old are you? They'll ask you questions about your income. So there are different risk tolerance questionnaires online to do a proper assessment of yourself so that you would know where you land up, and how you should be positioning your money. So that's really what your risk tolerance. And it's the first thing that you should do before you invest any money.
Thank you so much for that, Phil. And for me, I had to shift my mindset as to what risk tolerance is, and I'm sure our viewers can relate to that, because I see where we're searching for things, guys, and I know you're shopping at Timo and Shein. So you create that risk by buying those clothes that may not fit. So the same way you are willing to make that risk, I think we could risk a little $100 to start investing. I just want to say that, I'm not judging you guys. I'm just talking to you collectively as consumers. Okay, so in that vein, let's talk about where you can start with $100. And for those who are watching this now live, if you have any comments, just head over to the comment section, and we will definitely ask Phil all the questions that you need answered. So we're watching this, we're like, all right, I want to invest. I have a little $100. Where do I start? Because I obviously there's a rhythm in investing and rhythm in putting aside that money that you have to change your mindset. So where do we begin?
Yeah, as I said, sorry, just you and I would say, starting with a mutual fund. Now, there are different types of mutual funds. So there are mutual funds that are geared towards short-term investing. So that would be money that you need within, the next 12 to 18 months, I would say, or 24 months, that kind of time period. And then there are mutual funds that are for more geared towards moderate or long-term growth. And you have to really understand what is in these mutual funds. So, as I said, a mutual fund, think of a basket of investments pooled together, managed by a professional money manager. And the good thing about a mutual fund is you have someone doing that hard work for you. You have someone doing that, what will be described as, the heavy lifting in assessing what type of investment goes inside, into this basket. So for someone who is saving, I would say for a short-term goal, like an income fund is a great start there. Or if you're saving towards an emergency fund, which everyone should have, by the way, you should have emergency money set aside before you start investing money to take care of whatever the emergency is. So a short-term, a more income type account, mutual fund. For a growth, the growth that you're looking for, I would say, is more a fund that has stocks in it. So it could be a combination of stocks and bonds, but the more equity, the more stocks, I would say, heavier weighting with a mutual fund. If there are more stocks in that basket, and I can explain what a stock and a bond is. I don't want to race ahead and make any assumptions. But a mutual fund, typical traditional mutual fund, would either have stocks, bonds, or a combination of and short combination of both, and short-term investments. And again, I would say why it's a great place for someone to start is because a lot of times people lack the knowledge. In this case, you're relying on a professional money manager, and there are people there, that's their job, to basically look at investments, make an assessment whether the investment is good or bad, or if it's fit for that basket of securities and whatever the investment objective is, whether it's a short-term goal, medium-term goal, and a long-term goal. So it's important to ask if you're going to any financial institution, you should always ask the representative those types of questions, because you have to know what you're saving towards. A lot of times you might end up putting money in an account, an investment account that is not geared towards the goal. So you should accept, for example, if you're working towards like a long-term goal, you don't want to put that money in an income fund with short-term securities, which is more safe money, but very low risk. You're investing there and thinking that you're investing for, a long-term goal. That's a mistake that sometimes people make. They may not be aware of the type of investment account that they have, and maybe they didn't pay attention when the representatives were speaking to them, or maybe the representative did not do a good enough job of explaining what type of investment product or investment account someone would be or should be investing in. So a mutual fund is, I would say, take the $100, and yes, you can start with as little as $100, because I'm sure sometimes people say, well, I think you probably need $1,000 or 10,000. You can start with as little as $100 and have access to stocks and bonds and in an investment account that could start you on a journey to achieving your financial goals.
Okay, thank you so much for that, Phil. We have a lot of questions in the comments, and guys, we're going to get to that. Also, I just want to mention, Jamilia, on YouTube, you're asking what is the risk, but maybe we missed that with our conversation. So just expand on that, any comments, so when we come back after the break, we'll answer your question. So we have a lot to cover in the next 45 minutes, so stick around. We'll be right back.
Tired of feeling lost when it comes to your money? Want to make your money work more for you? Then tune in to Straight Off the Bat, brought to you by the Bankers Association of Trinidad and Tobago. Every Monday at 8:30 p.m. on TV6, right after the news. We'll give you practical tools and strategies to help you manage your money wisely, from budgeting basics, debt management, to wealth creation. We'll cover it all. No jargon, just straight talk. Join our host, Pauline Joseph, as she speaks to experts across the industry to empower you to take control of your money. Straight Off the Bat, Mondays at 8:30 p.m. on TV6. Brought to you by the Bankers Association of Trinidad and Tobago.
And welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from YouTube, don't forget to subscribe to our page to continue seeing content that will help you manage your money. Today, we are discussing what every beginner should know about investing in Trinidad and Tobago. And we are joined by Philip. He is an OG of the Straight Off the Bat series, and we are grateful for his knowledge. I'm just going to get right into it because we covered a lot of things when we started earlier today. So if you missed anything, when this live is over, you can check it on the replay across social media. Look for Bankers Association of Trinidad and Tobago. So we are talking about investing. We're talking about micro investing. And you shared a few words there that maybe not be common knowledge to a lot of us. So maybe just break down in the simplest of forms for the common man, me, what is the difference between stocks, bonds, and mutual funds? Because this language, you see on movies like Wolf of Wall Street, but what exactly does this all mean? So give us some insight.
So, sure, Pauline. So a stock is just think of ownership in a company. But let me just break that down very simple. There are two ways that a company can raise financing to do whatever business that they want to do. They can either borrow or they can give up a part of the company to investors, and then investors have an opportunity to share in those profits. So a stock, in very simple language, is ownership in a company. When you buy a share or you have a stock, you are a part owner. You are actually a owner. And I often like to let people know that many of the places where you shop, if you have a loan with any one of the big financial institutions, if you shop in certain supermarkets, if you purchase certain cars, there are different companies that are listed on the Trinidad and Tobago Stock Exchange. And when you shop there, or when you pay a loan and the interest you pay on the loan, you contribute to those profits. And you don't only have to be a consumer, you can also be an investor. I just want to let you know that, right? But just think of a stock. I would say the easy way, it's simple language. Think of like a family run, if there was a family run mom and pop shop, or what we would call a parlor. If this family wanted to expand and become let's say a big grocery chain, what they would do, and they didn't have enough money, you would say, listen, they go to investors, get some people to invest so that they can expand. These people now are owners of this business. Let's say a big bank some financial institution will pull the deal together, get all the legal things done so that they could put these shares or these stocks, make it available for investors. And the investors that put money into the business now are part owners. So as I said, think of the big banks, think of places where you shop certain groceries, think of household names, think of places where you may have purchased a car, things that you see, things that you may consume, whether it's alcohol, beverages, a lot of places where you shop. These companies are listed on the stock exchange, and what these companies have done to raise capital is they put shares on the stock exchange, make shares available to investors, and investors can invest, and you will be a part owner. That's what a stock is. You are buying into a company, and when you're buying into a company, essentially what you're saying is, or thinking is, listen, I have faith, I trust these managers to do a great job. I've seen what the companies have done, this company has done in the past 5, 10, 15, 20 years, or however long the company has been around. and I want to put my money there because I see what kind of profits they've made in the past. Doesn't mean that that's what's going to exactly be replicated in the future. But past performance doesn't necessarily say a company is going to continue, but it certainly builds a story for an investor, or it builds a story for someone to advise appropriately in terms of what is a good and a bad, or good or not so good investment. That's what a stock is: part ownership in a company. And there are two ways that you can earn with a stock. You bought the stock for $1. The company, let's say the shop, the grocery chain now is doing really well. They're making profits, they're expanding through Trinidad, and a lot of investors now seeing the good story say, listen, I want to have this stock. That pushes the stock price up. So now it's not $1, it's $1.50. So once you have that kind of demand from investors, that pushes the price up. When investors get scared and they feel a little bit jittery because of whatever management may be making bad decisions, things may not be as great in the economy. Those are things that can push a stock price down. Let me just pause. But if a stock price goes down, it doesn't mean that it's a bad investment. You have to figure out, well, if it's something. Sometimes, as I said, all stocks can feel the brunt of when things are not going that great in the economy. So, for example, when there was COVID, or for example, if you're following the international markets, the US stock market now, when Mr. Trump spoke about these tariffs that he placed on everybody in the world, investors got scared and they sold their stocks. So there are different reasons why stocks go up and down. But when we were talking about risk earlier, a stock there's risk attached to a stock. So a stock there's more risk with investing in stocks than there are with bonds, which I'm going to explain in a little while. And that's because companies are not guaranteed to make profits. Companies are subject to what happens in the economy. Companies are subject to what influential people may say. So you have to be mindful of that your dollar as it can go up, but it can also fluctuate, and it could be 95 cents. But in the long term, the stock market overall, the stock market trends up. So that is a stock. A bond, which is another way that companies raise money, by borrowing, the same way you would go to the bank to buy a car, to get a mortgage, or start a business. Governments have to borrow money sometimes to pay salaries, to build roads, to build bridges, to do what governments need to do for whatever, for the country. So they can borrow. They borrow. Companies also borrow as well, to buy computers and to buy desks and to expand, maybe purchase something in somewhere else. So companies are going to borrow as well. And a bond is a fancy word for a gigantic, just a massive loan to one of these entities. It could be a country. So they're sovereign bonds. That's bonds that countries issue. And when they say issue, issuer is already the borrower. So the government is borrowing from investors. And all governments it's normal, all governments around the world borrow, even the most powerful nations like the United States, and the countries borrow as well, and investors invest in these financial instruments called bonds, and you get a return on that investment. The key things to think about with a bond: it's a contractual agreement between the issuer, who's the borrower, and the investor, and interest is paid sometimes semi-annually, sometimes quarterly. But that's the what to pay attention is the coupon. The coupon is just a fancy name for an interest rate, and the amount being borrowed is the principal, and the maturity date, which is when the bond is going to end. So if an investor or a borrower issued a bond that's going to mature in 2026 or 2030, it just means that is the time that the bond has to be repaid and the investors get back their money. But along the life of this instrument or this bond, you get interest income, which is the coupon on the bond. Bond has less risk because it's a contractual agreement. So you know when you're going to get interest, you know when you're going to be repaid, versus a stock, which is profits can fluctuate, and the board, usually the owners of the company, determine how much profits they're going to share and if they're going to share profits. So that's the dynamic between a stock and a bond. Two forms of raising capital that a company, corporations raise capital, or a country. Well, in the case of a bond, yes. And then a mutual fund is a basket of these type of investments. So if you have a fixed income mutual fund, that fund is going to have mainly bonds in it. If you have a equity or a stock mutual fund, that fund has mainly stocks in it. And that's the type of investment that you're looking for growth. The fixed income mutual fund is the one that you're more looking for stable income and money that you know that you have either a saving for an emergency or short-term goal. And then there are also balance funds that has a blend. Someone says, I want to take some risk, so I want some stocks in there, but I want to balance off this risk with some bonds. And because depending on what's happening in the economy, these two types of investments perform differently. When people are excited and the economy is booming and companies are making profits, stock prices go up. It's the opposite when stock prices go down. When things are not great in the economy, stock prices go down. And when stock prices go down, people move into safer assets like bonds or feel more comfortable because I know when I'm going to get interest. I don't think I'm going to be, my capital is not going to fluctuate as much. So for an investor that's looking for a balance and says, what, I don't want to put all my money in stocks. I don't want to have all of it in bonds, and I want to have a balanced approach. You can invest in a balanced fund. So mutual fund is a basket of financial instruments, or like stocks, bonds, or both. It is managed by a professional money manager. So that's who's known as a portfolio manager. And the portfolio manager has, a team of analysts who goes into the financial statements to do basically what is a health check on a company, to look at the balance sheet and look at the profit and loss and look at the cash flows and make an assessment what this story that's being told about this company, and advise the portfolio manager to then make the final decision. Well, I'm going to put this stock or this bond in this portfolio. So it's just a basket of investments pulled together. That's a mutual fund, a stock, a bond. I know that was long-winded, but I hope that is simple enough to understand.
No, that's great. We definitely need that information because for us, it's our vision of it is what we see on TV. So the reality is a little different when you're from Trinidad and Tobago, and I think that is a great segue into a question we have on LinkedIn. I believe that's from Keisha. She wants to know what examples of mutual funds are available in Trinidad and Tobago.
Sure. So, I'll give you my experience. There are a number of mutual funds, right? The funds that I described. So there are growth funds, they're balance funds, funds invested exactly how I described earlier. There's almost 60 something registered funds from the different financial institutions. I will just say, I will share my personal experience, which is not an advertisement, but this has been my personal experience because I am a unit holder. So I have funds at the Unit Trust Corporation. And an example of growth type fund is the growth and income fund, which is invested in stocks on the local stock market. So some of the big names, the big banks, and those the big companies that you might see that you're more familiar with that are listed on the stock exchange, a fund like that would more than likely have stocks. There are stocks in it, and there are also bonds in it. Government of Trinidad and Tobago bonds that I explain, governments borrow, and also corporate bonds from corporations in Trinidad who may need to take a loan. So that is a balance fund. That's one type of fund. There's also a TT dollar income fund, which is made up mainly of short-term investments and bonds, long-term bonds and medium, some bonds longer, some bonds medium in terms of the time for it to mature. So a medium-term bond may be something 3 to 5 years, a long-term bond, a more longer-term bond will be something 5 to 10 years. And there are different types of bonds and different types of short-term instruments. But this is a safe type of investment and a good place to park your money and actually get a better return than you would get at the bank. So that's the good thing about a mutual fund. What I do know, I believe the TT dollar income fund is somewhere upwards, it's north of 3%. And that's a great return because you have access to the money. So you can get a card and you can have access to the money. So that's an example of type of funds. But I would say that has been my experience. That's a mutual fund that I hold. But there are also other mutual funds with other entities that you should also do your research to find out what is the best type of mutual fund for you. As I said, there are well over, it's close to 60 registered investment products that are registered with the Securities Exchange Commission. These are like the watchdog or the regulators that make sure that investors are protected. And so these funds are registered. Think of the big name financial institutions. Many of them offer mutual funds and they have a different focus. And I will encourage you to speak to the representative in a way where you get all of the information that you need to know that you are putting your money in an investment that is working towards the financial goal or the financial goals that you have.
Thanks for that, Philip. And I have to say, as you know, the host of the Bankers Association, Trinidad and Tobago Shit of the Back show, you definitely should have a discussion with your banker. So because the history is already there, that will be an easier conversation to have. So Dylan has some questions about micro investments and actually around mutual funds. So we'll get to that as well. And Jamila, I'm really sorry that you had to experience that. We're going to try to address your question right after we break. We'll see you. And welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from LinkedIn, don't forget to subscribe to our page to continue seeing content that will help you manage your money. Today, we are discussing what every beginner should know about investing in Trinidad and Tobago. And we are joined today by Philip Williams. We have so many questions in the comments. So I don't want to, for those who would have missed the first half of the show, not to worry. We will be available once the live show ends. It will be available across social media. So let's get to Jamelia because they've been on YouTube waiting for a while. Wanting to know what is the risk when investing your money? You will lose, will you lose the amount of money? And she goes on to say, sorry if she's a he. Person goes on to say, I have fallen to investment scams before, and it really upset me. How to look out for signs for some investment is a scam. So you want to address that?
Yes, I do. I do want to address that. That's a very, it's important. So, I'm sorry. First of all, I'm sorry to hear that. And, sometimes people say, boy, how you will let that happen to you and might say things that are not pleasant. They say, boy, how you fall for that. I'll tell you what, sometimes the most intelligent people fall prey to these types of scams or get rich quick schemes because it plays into your your emotions. So everybody, I understand the desire to get, to grow your money quickly and accumulate wealth, and you want it to happen quickly. But it doesn't work like that. And the first thing that the moment you hear a guaranteed returns are never guaranteed. So honest financial professional is going to come to you and say, listen, this is the type of investment. It's a registered investment. And there's a lot of information that is public that is there for you to make a determination. When there's limited information, when it's going to double and quadruple and your money is going to put in $1,000 and get back 50,000 in 4 weeks, put in 10,000 and get 100,000. Waste of time. Turn the other way. Don't even bother, right? Because it's easy. But what happens is, I think, because it's a pyramid, you may have a friend, they put in money, they got it, somebody puts in. So it's like a merry-go-round until, musical chairs, until the music stops. And then now you might be that person that's caught. So I would say never do it. But some people still do it because they say, you know what, I'm going to take the risk. I know I can lose, but I might be one of those lucky people. So the double and triple the money, stay away from it, right? It does not work like that. The fastest way and the best return that you can give yourself is to consistently invest every time you earn an income. So think of this way. If you had $100 and you're earning 10% on it, that's great. But you put in another $100 the following month, you're earning 10% on now 200. You put in another 100 the following month, you have $300, you're earning 10% on 300. The best return that you can give yourself is to be consistent. And that to me is what I observe is the most challenging part in investments. Not really making an investment. The most challenging part is the discipline to stay consistent. Because a lot of times people, you accumulate a lump sum and you say, I have this $5,000, I have this $10,000. Let me just put it and they expect it to magically grow 5, 10, 15, 20. It doesn't work like that. You have to stay consistent. So even if the lump sum is 5,000 or 10,000 and you have 1,000 or 500 to contribute every month, then that's what you do. Stay clear of anything that sounds too good to be true. More than likely, it's going to be too good to be true. And a good question to ask any one of those people that come to you is, what is really driving these returns? What's driving these astronomical returns? And if they don't have an answer for you, then it's just they're trying to scam you. So something has to be, there's something behind the scenes producing a return. Just like a bank, the raw material of a bank is selling loans. When the bank sells a loan, we pay interest and the bank makes profits. And somebody sells groceries and people buy groceries, they put a markup on the groceries and whatever service they offer you, and that drives the returns of assets. If somebody is borrowing money with a bond, you know that the interest is being paid. You know what is driving the return on different types of investments. Those things they wouldn't tell you. They can't tell you because there's nothing behind back in what the scheme, back in what they're doing. So I wouldn't even call it an investment. So stay clear of those things. Don't engage at all. And as I said, the best return that you can give yourself is to stay consistent, and know that you only have a certain number of paychecks. And when you start thinking like that, I only have a certain number of paychecks. Okay, this is one less opportunity for me to push towards my financial goal. And if I missed it this month, sometimes you might be budgeting and you didn't do too great with your budget, you missed it. But I would say, as an investor, every opportunity that you get, when you get the big bonus, you deserve to treat yourself, and because you've worked hard, but you also deserve to give yourself those the reward of a long something for your future self, whether it is retirement, whether it is some type of asset that's going to generate money for you. So I think that is the difficult part with investing, not necessarily knowing what to invest in, and that you can get that from a good financial advisor or a financial institution that gives you that information, and you ask the questions that you need to ask before you make an investment. I think the most difficult thing is managing the emotions and being disciplined. The human aspect of it, the behavioral aspect of it, that's the most difficult part. That's what I have seen.
Okay.
Was it a two-part question? I know it was getting, yes, I got scammed. What was it? Was there something else I missed?
No, that was it. I
Okay.
think we've also first of all, thank you so much, Amelia, for sharing that, because I know that would have been hard. Our society does shame us into sharing the vulnerabilities that we've experienced. But we've also put in the comments, because we've covered this in length. Learn more about how to identify investment scams in the comment section on YouTube and Facebook. So you can check that out after the live show, because we have a lot to cover here today. And I really like what you said, Phil, earlier about you only have so many paychecks.
That's true.
Because when you now start to enter the workforce, you're like, oh my gosh, yeah.
Yes.
And then when you settle down and you get married, you're like, oh well, kids and so forth, or like me triathlon. But then you're not thinking about retirement, because it's like, okay, I'm now making enough money to enjoy it. But the idea of there's a finite amount of checks really puts things
Yes.
in perspective. So we're gonna head back into the comments. We have quite a few, so I'm gonna go back up, because we had a very good question from Dylan. Have a UTC account and want to know if that is investing? And also, how can someone open a micro investment account as the brokers usually have a minimum starting amount at 1,000 or 10,000, etc.?
Yeah, good question, Dylan. Yes, if you have an account at Unit Trust Corporation, you are an investor. What I will urge you is to speak to a representative at UTC to find out if you're not sure exactly what type of account you have. If it's a short-term account, which is the TT Dollar Income Fund, then you're saving for, short-term. It's a short-term investment. If it's a long-term or medium-term account, that's more than likely the growth and income fund. So yes, you are an investor, and I will encourage you again to just be deliberate, be consistent, and know that the best return that you can give yourself is to contribute money to whatever the investment is. Micro investing, so I would say I do know of two, there are 8 brokers, and 2 of them I know for certain. The starting amount is $2,500 to start with. Some of them are depending on like when they have IPOs, which is remember I was talking about stocks coming to the market for the first time, an initial public offering. So a company is making their stocks available or shares available to investors. Some companies, some brokers actually let you open a brokerage account with no money in it, or with limited amount, so less than 2,500. There are other brokers I think might go as high as the minimum amount as 25,000, sorry. On the topic of the micro investing, as I said, I have not seen much of it in terms of how my interpretation of it is, which is either done through an app or some kind electronically automated, that the small amounts that you just consistently investing consistently, which and again that is automated. So it takes even that level of consciousness in terms of you having to, it's done automatically. I haven't seen much of that, but in terms of I would say how I will equate micro investing in Trinidad is that starting an account with as an investment account with as little as $100, right? If that's all that you have to start with, you can start with as little as $100. So that's how I would say, don't think about your small investment, and think about you consistently contributing, and think about your money growing in the long term. Because before you know it, 12 months passed, you started the year, January 2025, you said you were going to save and start investing. It's almost half the year has gone. I don't know where the year went. And that's what happens. As time goes by, now you're drawing closer to whatever goal you're working towards it. Let's say you wanted to have this goal, financial goal, achieved in 3 years or 5 years or 10 years. That's the time it's going to take. So be deliberate with your time. Understand that time is also precious when it comes to your money. So the faster that you start setting your money aside is the best chance you have towards working towards your financial goals. And if you want to get a brokerage account open, I can certainly assist. If you message me on my page, I can put you in touch with a broker that can open an account with as little as $2,500.
Okay. So, for those who may want to know how to extend this conversation, because there's a lot of comments, I'm hoping that we get to all, but we may not. Head over to our comment section and make sure and sign up, because there we will follow up with any questions you may have, and you can reach out to us and let us know. So before we go on the break, I want to address Siobhan's question on Facebook. Morning, I've been in mutual funds for a long time, but it's short term. I'm satisfied with its growth so far. Siobhan, I'm jealous of you. So my question is, what would be another good investment along that line?
Yes. All right. Well, I'm Siobhan, I'm very happy for you, and congratulations on being an investor and watching your money work for you. I would say, for if you have mutual funds, I would say the next move for you, once you have assessed yourself as an investor in terms of what type of risk tolerance, what you're prepared, the risk you're prepared to take, I would say the next move for you is to open a brokerage account. There are 8 registered brokers, and because a brokerage account is your passageway towards the stock market. Your brokerage account is your passageway to have access to these profits in some of these places where you spend your hard-earned money. The brokerage account is is the route for you to get your money working harder for you. So the mutual fund is working hard. I would say look to the stock market and look to invest in some of the the strong companies that we have listed that make profits. So now you can have a share in those profits. Those profits are called, I think I didn't mention it earlier. So how you earn the profits are called dividends. And when the company makes profits quarterly, semi-annually, annually, the board of directors, the owners will come together and say, hey, look at the financial statements. We've done really well. This is the amount of we want to share with the shareholders who we have on record. So again, if you don't follow Filigap, you should follow Filigap. I answer all questions. So even some questions were not answered today. You can message me, send a direct message on most times I would say Instagram, but I do get messages on Facebook, and I can answer how you can start open a brokerage account and how you can get access to the stock market. But I think your next move should be thinking about investing in some stocks to get that long-term growth. That's a good complement to the mutual funds that you already have.
Yes, definitely great to see that that is happening. Folks are going beyond just short-term investment, and we want to continue the conversation because we have quite a few questions to get to, but we will get to them right after the break. And welcome back to Straight Off the Bat, the show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from Facebook, thank you again. Don't forget to subscribe to our page to continue seeing content that will help you manage your money. Today, we're discussing what every beginner should know about investing in Trinidad and Tobago, and we are joined by Phil Williams of Phil the Gap. We have covered an extensive amount of information. We don't have much time, but you can catch the replay across social media and now on TV6 on Mondays. I know. Woo, yay! All right, so we're going to head back to the comments because, guys, I'm going to do my best because I have questions. Clearly, that doesn't matter. So I'm going to head over to the comments again because there was a question that extend. Oh, okay. So Nabila Holder from Facebook wants to know what are some local bond examples. Did you cover that before? I know you were discussing it, but I wasn't sure, so I wanted to ask that question.
Yeah, I explained what a bond is. I didn't go into very specific example, but I would say if you so the government of Trinidad and Tobago bonds. There's an NGC bond, which is the gas company in Trinidad and Tobago. There are different entities that issue, as I said, issue as a borrower. Sometimes it's difficult to have direct access to a bond, but the indirect way to get access to a bond is to invest in an income fund, because the income fund is going to have these bonds in it and it's going to share the interest income with you. But I would say a good example of a bond that most recently, I guess without name dropping, but I guess people would have seen this in the papers. Massey just issued 2 bonds, 2 fixed income instruments, 300. I think they were both worth 300 million. That was the most recent bond that I've seen. That's a couple of weeks or that's about a month ago. And again, that is a company, Massey, coming to the market to borrow money to do what they need to do, right? To transact and do their business and support or serve their customers. An indirect way, again, is participating is if a mutual fund purchased this bond, which sometimes it may be difficult, because sometimes the mutual fund, because of how the industry is regulated, They may not be able to tell you directly, listen, we have this bond, that bond, or we investing, but they can give you a broad picture. But again, a good way to have access to fixed income type in investments is to invest in an income fund. The income fund is going to have government bonds. The income fund is going to have corporate bonds, like what I just described there, and they're going to have short-term investments that mature in less than a year, which like a money market type instrument. So it's money being lent, money being lent to an institution for different periods, short, medium, and long term, and the interest income from these arrangements. This is what pays investors.
Okay, so just want to reiterate, guys, watching this now live on the replay, I would also suggest you reach out to your bankers, to have that discussion and start, because information is power. And I think this is a great way for us to have those conversations. Now, we don't have much time, but I want to hand over to Gen on Facebook and wants to know, as a single parent, what is the best product to invest in to get high yield interest rates?
Yeah. Is this as a parent investing for a child? I'll answer. I think the best way is to invest in some stocks or invest in a mutual fund that is heavily has a large allocation towards the stock market. And the reason for that is, even though there's risk in investing, if you're investing for a child or a young person, that individual has a lot of time to deal with the ups and downs versus somebody who's now on the verge of retirement or in that retirement phase. You don't want to be taking that type of risk. So as you get more seasoned in your career, as you get older, you want to be taking less risk. But the earlier, when you're in the early stage of investing, a young person, particularly if you're investing for a child, you want to invest in a mutual fund. And there are mutual funds that are geared towards children. And those types of mutual funds have a heavy allocation to the stock market. So a question for you to ask the representative is, what's inside this investment product? What's inside of this investment? And is it best suited for me investing for my child? And they will tell you, yes, the fund it has a heavy allocation to stocks on the stock market, and stocks on the local stock market, stocks on the international stock market. So some of the things, there are mutual funds that also give you access to some of the things that that you use. If you agree on Facebook, some of these mutual funds invest in Meta and these type of companies, big companies in the United States and around the world, and you have access also to those type of investments through a mutual fund. I can't emphasize this enough. A mutual fund is going to give you access to investments that you would not ordinarily have access to, one, because of the scale or just access to foreign currency, different things. So a mutual fund and the stock market, right, is a mutual fund with stocks in it, heavy allocation of stocks, as well as the stock market, investing in some of the quality or strong companies listed on our local stock exchange, is a great way to start investing for your child, whether it is to just give them a head start in life when they reach 18, 19, 20, or whether it is to send them to university, whatever the goal is. So I think that's a great starting point for someone who's thinking about investing for their child. If I interpreted the question correctly or incorrectly, I think the other way that question would have been worded is, if I am a single parent, I just want to invest. Maybe I think I don't have enough. Maybe I don't feel confident. Maybe I think I'm waiting on the bigger raise. So I would say definitely single parent to me suggests that you probably have one income. So you have to be the best steward that you can be for you and your child. And a great steward will have all of your expenses written down and how your income lines up at the end of the month. And think about the things that are may be negotiable. So there are some things that are non-negotiable. A good rule is the 50-30-20 rule. 50% has to go to the bills, the light bills, the groceries, the things that you have to do. 30% go to your wants, maybe whatever those wants are, and 20% should go towards saving and investing. And I like to flip that rule is because you should be thinking of yourself first before you pay anybody else. So one man's income or one individual's income is spending is someone else's income, right? Before you pay the bills, before you do anything, you should have a certain amount. Whether it could be, if it's not 20%, then start with 10%. If you don't have 10%, you just save 5% of your each. Always strive to save something. That that benefit of getting that discipline is priceless, because what's going to happen is when you get the raise, when you get the bonus, you have that discipline instilled in you. You'd be surprised if you don't have a budget. If the budget is in your head, I will urge you to get an expense tracker on your phone. Technology is available. You should track your expenses so that you would know. You'd be surprised, so that you know exactly where your money is going and where some of the places that you can save. And you might think, what, $100 is not really much, right? If you save 100 every week, that's 400. If you made an, that's 400 a month. Think about what that would be in a year. So every opportunity that you get to save, as little as it is, particularly for any single parent out there, seize the opportunity and just come to terms with and accept that every time that you get income, it's an opportunity for you to make the right decision for you and your family and do the best that you can do with your money. Right? I always encourage people. Sometimes you might see somebody who's living in a big house or driving a fancy car, and it might, you might say, well, they have it all together. But sometimes, a lot of times, you never know. This person might be one paycheck away from losing their home. They're not saving any money. They look flashy. Or they may have it together. I don't know. But the important message here is for you to stay in your financial lane and to work with what you have and do the best with what you have. And doing the best means that you're budgeting for your life. You know exactly what's coming in. You know exactly what's going out, and you are diligently and consistently working towards your goals.
Okay. And I hope we cover that again. And as someone who was a former child, I can also suggest that you encourage your child or children to be part of that conversation, because then it's easier as they grow as an adult to have savings built in as a habit. Because I'm still working on it, guys. I'm still working on it. All right. So we don't have that much time. Just shout out to Angel on Facebook. I believe we covered that question about investing from a start as low as 1,000 US. But let us know in the comments and we can get back to that. It looks like we may have to have Phil back at some point in time because we cannot get all of these questions. But I will finish with Mikoyo Khan. Miko Khan. Oh my goodness, sorry. Mikoyan. From Facebook wants you to explain how to research and understand. And I think, joining this live stream is a great start, Koyan. But just to close off, Phil, can you just share some insights on where to have this information? Because, information is a boundary in the information age, but there's so much we can get overwhelmed. Where do we go as it relates to investing in Trinidad and Tobago? Where do we start?
This is to do research on a particular company, or is it to research just investing on the whole?
Just investing on the whole.
Yeah, so I would say start with so financial institutions usually have a section on their webpage that for education. The stock exchange does a great job. The Securities Exchange Commission has their tabs that says financial education. The National Financial Literacy Program on the central bank. I think these things are available and people are not, they don't really utilize them. So those are great places to get great resources. The Trinidad and Tobago Stock Exchange website has all of the information, I would say, for a beginner investor. The central bank, through their National Financial Literacy Program, great education tips there. The Securities Exchange Commission as well. And most of the financial institutions, I would say, are very responsible citizens, to help citizens, responsible in terms of putting information on their webpage to help citizens navigate this investment landscape. And if all else fails, you follow Fill the Gap. Follow PHILTHAGAPTT. I speak about all things investing, personal finance, investing, education, things that may seem macro and not understand how it happens in the economy and how it impacts you. I post weekly on things that impact you, and you also have access to ask me questions, so you can follow. And there are also other financial influencers. A finfluencer is a great resource. A trusted financial influencer is also a great space to have access to someone who you may not get to talk to at the bank all the time. You may not get to speak to someone at the Securities Exchange Commission or the central bank or the stock exchange. I would say financial influencers like myself who are reputable and have a good background in finance is a great resource to answer your questions and point you in the right direction so that you're doing the best with your money, for yourself, for your family, and for your future.
Okay. Well, thank you so much on that note, Philip. Thank you so much again for joining us. You clearly are in demand because unfortunately we can't get to all the comments. Safi, Kelly, on Facebook, Adrian, we want to get to your comments. Unfortunately, our time is up, but we're gonna try and convince the powers that be if we can bring Phil back to extend this conversation. But you can surely join us on our newsletter, which is available on the comment section. Maybe it's there, maybe it's there, maybe it's there. I don't know. Depends on where you're watching this. So ensure to follow us on social media to carry on the conversation. So thanks again to Philip for joining us today and sharing insight into what every beginner should know about investing in Trinidad and Tobago. And again, sign up to be notified about our next live show via the comment section. And as always, be sure to follow us on social media so you don't miss a single live show. Thank you so much again for joining us. Bye.